From the morning reading, gap open, retrace, buyers join in, the spider forms a hammer. 6 of 9 sectors moved higher on Thursday. XLU, XLP, and XLB were the strongest sectors, while XLV was the weakest sector. Oil futures rose 46 cents to close at 46.45. Breadth strengthened as decliners led 1577 to 1452 on the New York Stock Exchange and led 1731 to 866 on the Nasdaq. The retail sector has gotten hit, and those hits keep on coming. The sector is down nearly 20% from its high in the past year. There is concern that this is a harbinger for weakness in other sectors and the stock market in general. The few other times retail diverged so negatively from the broader market, it did serve as a modestly successful warning sign. Individuals are really hesitant to buy this rally. The latest sign comes from the AAII sentiment survey, which showed an exceptionally low percentage of bulls. When stocks are within a few percent of a new high, it's odd to see such apathy from these investors, and it's not necessarily been a good sign. It isn't just individuals anymore. Active investment managers reduced their exposure to stocks from an average of more than 80% 3 weeks ago, which was excessive, to below 50% this week. That doesn't tell us much other than their overexposure has been erased. Only 40% of consumer discretionary stocks are trading above their 50-day average. That's a low number given that the XLY fund is within 3% of its 52-week high. The only other times this has happened were in May of 2006, June 2015, and again December 2015. All three instances led to weakness in XLY over the next 1 to 3 months. We currently are forming a head and shoulder pattern across a number of the indices, which is bearish. Indicators in the shorter term are somewhat bullish, but the intermediate term indicators are clearly bearish. The estimate is that the short-term bounce is over. Short-term indicators will be catching up soon as they are already in somewhat overbought territory. If we didn't get follow-through on Tuesday's big rally, don't suspect we will get until price has at least tested what will be a neckline of the head and shoulders pattern. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:18 a.m. Central Time, and I'm recording this in preparation for the market day of May the 13th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And we did have some pretty interesting action last night. We were down in all 4 broad market U.S. indices, about 1/3% at the time of this cut in the S&P futures, or about 7 points. And the Russell, it's down nearly 2/3 of a point, and then about 1/3 of a point in the Nasdaq and Dow futures. And crude oil down over 1%. Euro down about 1/4%. Bonds up about 0.5%, and gold up nearly 0.5%. China is also down about 1/3%. Hong Kong down about 1%. Japan down about 1.5%. Germany down over 0.5%. And United Kingdom down about 2/3%. In terms of macroeconomic reports for today in the United States of note, there's a pretty good slate for a Friday. Core retail sales, PPI, retail sales month over month, core PPI month over month, and the University of Michigan Consumer Sentiment Report. In terms of current volatility conditions, things have been, in general, decreasing in the big picture, 5-day over 10-day. Short-term VIX is at 13.46, so relatively low. Skew is benign. IV percentiles across all 4 indices continue to be extremely low, with the S&P at a 12, the Russell at a 16, the Nasdaq at a 13, and the Dow at a 7. No standard deviation moves were put in on a close-to-close basis yesterday, but as we'll see when we go to the charts, there was plenty of range. but we pretty much ended up right back where we started on the day. That was preceded, of course, by the prior two sessions, which had standard deviation moves going in opposite directions. So it's a pretty interesting combination of recent action. Let's go ahead and go to those charts. So we'll start out with the S&P futures chart, and this will show us the overnight action. You can see it's been a pretty interesting day already as we press down in the overnight. Now we've had really a confluence of factors coming together to set up some pretty interesting potentials. First of all, let's kind of set the stage. Obviously, we've had the big run up since February, and we've run right up practically to the tick to this very important area of resistance above. And now we also have another area of resistance in that we've had this diagonal resistance line form, and that certainly has been honored with the recent swing high. That makes it even more powerful and certainly makes any upward move probably quite limited without having to overcome some fairly important resistance. Nowhere near as important as this area up here, just over 2100, but certainly there's two significant, what we'll call it really three, four, maybe even four lines in the sand that are all stacked above our current price action. You'd have to get, if we were to turn bullish, you'd have to get through this resistance, this horizontal resistance from the swing, this from this swing, and then of course the area up here at 2100. So in the space of about 40 points there, you have four lines in the sand of resistance, and with the last one being the most important. It is going to be really hard fight to be able to get much headway for the bulls through this area. Now, the more important thing perhaps at this point is this potential head and shoulders chart pattern. And if you'll follow me here, you see this right here. That's the left shoulder. Here's the head. And now with this recent rollover, we have confirmed, the right shoulder. Now, what we'll look for this to fire, so we had the potential head and shoulders pattern, but it hasn't fired yet. So we need to break the neckline, and the neckline, of course, would be across this area right here where we already had previously drawn a area of support. So does it come down here? We've got, in essence, several touches of this area, and you have the cloud, which represents very much the same thing. Does this area hold? Do we get down here to the very important 20, 25, 20, 30 area and find that action holds? If that does hold, then we probably just denigrate into a sideways pattern, which is what we've been talking about in recent days. The question, though, is if it doesn't hold, then what? Well, you take the measured move from the head and shoulders pattern and you project that, and we would probably come down here to roughly in alignment with these early March swing lows. That would send us probably down around 1920. This would be representing an additional 100-point drop and a pretty significant pullback into correction potential territory for the S&P futures. So this is just a possibility at this point, but head and shoulder patterns are one of the more interesting chart patterns, especially on the intermediate term basis. This took weeks to form, and the probabilities for that, if it fires, to make a fairly significant move is pretty decent. So definitely something to watch. So first order of business probably in the near term is that we continue to chop in this ever compressing zone between the resistance and support, and then at some point perhaps break down. And we may break down through the head and shoulders neckline, or we may just denigrate into more of a sideways pattern. On the Dow, we have very much the same pattern. There's the one shoulder, there's the head, and now there's the right shoulder. So very much the same pattern setting up there. On the Nasdaq, we have just in general a weaker pattern overall. I'm not sure that I would draw a head and shoulders. Some people might try to draw a head and shoulders perhaps here, here, and then here. Bottom line to it is, if that were to break and you see you have a kind of neckline across here, that would probably take you all the way down to the lows or near those lows. So for the Nasdaq, that could be a full 100% retracement off of the February swing low. Again, these are just potentials. I'm not giving probabilities to these things at this point. But if you should see us visit that neckline areas of the indices, you've got to watch that area very carefully, and it should be part of your hedging strategies to your core portfolio, and especially if we should break through that area, to be prepared for the possibility that we could see a 100-point drop in the S&P is absolutely on the table. In terms of the Russell, again, you could call this a head and shoulders pattern as well. Very much similar patterns to what we have coming in. If you got back down to these March lows, that would take the Russell probably down to about 1050. So you could see pretty significant moves could be forecast across each of these indices. So how likely is that to happen? Well, of course, we've got, overnight action right now is relatively weak, but nothing, super pronounced. We would certainly want to see that the bonds break out. And right now, it's up against this area of resistance, and that is holding. So we don't see that bonds are breaking up. Bonds break up, equities probably break down. So that's not telling us that it's about to happen quite yet. Now we can take a look at the volatility. Volatility is not looking like it's getting ready to explode up. And here's your regular VIX. And in fact, on both these charts, there's quite a bit of overhead resistance. So I show that to kind of bring back this thought that, the equities, while you may hear in the mass media today, the financial media, talks about head and shoulders patterns as we've gotten this right shoulder form. It's an interesting development, and it certainly has significant potentials, but we're not there yet in terms of a high probability outcome on that. The VIX and the bonds are not telling us that this is imminent yet. Now, they could both break out, and if they were to break out, then the probabilities start to climb. So watch these correlations between these different markets and see how they set up, and if they're telling you that something bigger is starting to move and is afoot. We'll also take a look at gold. And gold continues this really messy consolidation pattern. Still expect this to break to the long side at some point, but you're going to probably have to be very patient. And then one morning you'll get up and then bang, it's already there. Is so often the case with the gold market. Also, if we should break with the head and shoulders patterns, you would likely see a flight to safety, and gold does carry some of those characteristics, and that could very easily be the impetus for a gold breakout to the long side. So this is a related correlation. And then, of course, let's take a quick look at crude oil. Crude oil has seemingly been so correlated with many of the moves of late, and it seems to be stalling right now, but the expectation is that this would probably continue to move up, and certainly if it breaks through this most recent area of resistance, it certainly has a little bit of room to go up to about 48.5, and then from there up to about 51 would not be too much of a stretch. So crude oil, there are some people espousing that we could be going back to 60, and you can see this very significant area of resistance at 60, that we could go back to 60. That is not improbable at all. At the same time, there's other people who are arguing that we're going to 20. Right now, given where we are with the intermediate term pattern and so forth, I would say that the 60 seems more probable than the 20, but if we have a recessionary cycle start to develop in our business cycle and the market starts to break down into significant correction territory or bear market kind of territory, crude oil would certainly be taking a hit along with that. Now, oftentimes recessions are actually preceded by higher crude oil, but given the current supply issues, the oversupply issues related to the crude oil market, it's hard to see that that is going to be much of a play in this current cycle. We'll see how it develops. So let's go ahead and go to the daily report. And we continue to see interesting developments here and in just kind of this slow, methodical degradation in many of the most important indicators. We've already had this market trend intermediate term phase opinion at phase 5 for some time now, with the in short term as the short description, the break of diagonal and horizontal support. All three of our market timing signals are signaling, warnings to various degrees, with the IBD signal uptrend under pressure. The second signal, GMI index, only a 3 out of 6 with a sell signal that's been in place since May the 4th. That author remains mostly in cash. And then our third signal that we follow, the stock charts decision point scoreboard, with a very poor looking short and long term, and then now the intermediate term is starting to show signs of degradation as well. Consensus of these signals right now is clearly market in transition with a significant bias to the bear side. In terms of position sizing opinion, it's at 50% for the portfolio model and 75% for the volatility model. So certainly warnings flashing there as well. Intermediate term market posture, this is one that is perhaps in support of the bulls, that this is not going to go very far. Right now, weak bull conditions exist for 3 of the 4 indices, including the more important S&P. Now, this is about a second day signal, and when I see these signals reverse in this area of the indicator and turn from a bear signal into a weak bull, I often expect that there'll be failure in those signals. So I'm pretty suspect of this particular signal at this point. So watching to see, just where price action takes us in the short term, and do we firm this up and we gain confidence in this weak bull, or is this just a kind of a bear flag bounce, giving us a little bit of a whiplash signal here, just in short-term fail. But it is an intermediate-term signal. It does say weak bull at this point. We have a strong sentiment line that's supportive of this. So this could be part of the evidence that supports the theory that we just trade in a sideways range and don't really achieve anything in terms of breakout to the bull side or break down to the bear side. So this is the kind of stuff that you get when you get sideways and choppy markets. In terms of the hedge warning status, we're currently level 1+, caution with an increasing number of warnings firing. In terms of our strategy opinions, I won't spend a lot of time on this. All week we have been with the exact same opinion. VIX is in the acceptable window for option income strategies, and that may very well be one of the better strategies for the summer if we do go sideways. However, there's multiple warnings firing, and that suggests, some significant defensiveness on the initiation of new positions. Consider your position size, especially. This is not just a warm, fuzzy bull market in summer doldrums. It's not that. So you got to make adjustments with your strategies to take that into consideration. Cover calls and put selling, conditions not acceptable for novice traders at this time. And I say that with an asterisk. Frankly, we do have weak bull. We frankly mechanically have a signal that gives us permission to do both covered calls and put selling new positions for short and intermediate term bullish positions. But given the context of everything that we're seeing from the various warnings, we're being a bit more defensive right now, especially as we see this head and shoulders pattern form. There's real potential that this could get pretty ugly and would wipe out, you know, the advantage covered calls and even put selling might give you compared to where we might be in a week or two. So it's a pretty tenuous point right now. So in terms of specific warnings, you can see some of these actually ebbed off yesterday and went back to normal status. We do still have this volatility ratio warning in the reversal zone. Has not yet fired, but it's been firing and then going back into the reversal zone and kind of repeating that cycle without actually seeing the market break down. So we'll continue to watch where that goes. Distribution day count remains elevated with the Nasdaq at 8, the S&P at 7. Current 10-day expected move is up over 40 at this point. So that is a warning in itself. Trend signs, you know, this phase 5 certainly is one signal. And then, of course, another one is didn't actually technically achieve warning status. New York Stock Exchange, new highs, new lows. At 300, we would call this a warning. Well, it was at 295. So spirit of it, certainly on a rounding, we could call this a bit of a, you know, a low-grade warning on the fact that we had so many new lows put in yesterday. On the key intermarket risk aversion indicators, all 5 are still risk off, though one actually is in position to roll up and signal risk on. So we'll see where that develops. Sentiment indicators and stocks, you know, relatively benign. Bonds and gold a bit elevated. Watch for potential reversal patterns there. On the fear and greed index, the summation of 7 different indicators rolled up into one score. That's a 61, so relatively neutral on that at this point. In terms of the sector specific, yesterday after that action, you see the short to intermediate term. We continue to have quite a mixed bag here. Pretty much Christmas tree on those 2 time frames with every single color present. So let's dig a little bit into what's the most consistent. Consumer staples, energy, and utilities. Well, 2 of the 3 of those are defensive in nature, so that is of interest. Also of interest are the ones that are most consistently down: transportation, healthcare, specifically biotech, dragging down the healthcare sector, and then retail. Retail was mentioned by one of the morning authors and has just been pummeled of late. And indeed, retail is also coming into a seasonally kind of down period, so to keep that in mind. And there's some wonder as to whether retail may be dragging down the rest of the market as a bit of a warning sign of what the consumer is doing. In terms of percent change, you see, you know, telecom, staples, utilities. So 3 of the top 4 sectors yesterday in terms of percent gain were the defensive sectors, you know, those places where people go for dividend paying, kind of more stable stocks. And whereas, you know, many of the higher beta down here in the bottom half. So it was that kind of day. So I think that's probably enough for today. We've gone over our 20-minute limit again, but a lot of really interesting things happening with that head and shoulders pattern developing. So we're going to go ahead and scroll through the wrap-up section. If you see something of interest, just hit the pause button and go to the hyperlink, get your additional information. There's a lot of information on these slides, which I generally talk more about when we have a little less to go on with the charts and so forth. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And then at the bottom here, you see the hyperlink that takes you to the full set of disclosures. Meantime, we'll see you back here for the Monday morning market preview from Falcon Global. In the meantime, good trading.